Capital gains tax changes, here's how to beat them. So the changes to capital gains tax, I thought it would be very helpful if we did a worked example of a recent case that we had, which allowed us to mitigate the capital gains tax payable. And that is, of course, with the use of SSAS, which is an excellent vehicle for protecting your assets from just this tax. We've had the budget and there have been some changes to capital gains tax. I thought it was worth, firstly, just explaining what capital gains tax is. Capital gains tax is paid both by companies and by individuals. For example, if you, as an individual, buy, say, a second home and this rises in value, the increase in value over the original purchase price, less costs, is potentially liable to capital gains tax. There used to be some good allowances that you could deduct from capital gains tax, but these have been eroded steadily over the last few years. Similarly, if you run a limited company, and again, if you buy an asset such as a commercial property or land inside your company, then the rise in value of that asset, again, and there may be some deductions for expenses, the rise in that value, less any costs, is potentially liable to capital gains tax on the company. However, if you are looking to potentially mitigate capital gains tax, then you should be looking at SSAS, particularly if you have a company. So if you run your own company, so you've got a nice SME and you are a director of that company and you really want to try and avoid the capital gains tax rises and issues, then have a look at SSAS, because SSAS is a pension scheme of the company. So your limited company would set up the SSAS. You and say your spouse or your directors can be members of that SSAS. Obviously the company can put contributions in for you. You can transfer in existing pensions if you wish to do so. But the great advantage of a SSAS pension is that the assets it holds within are statutorily exempt from capital gains tax. They're also exempt from inheritance tax and tax on the profits, income profits from investments that you may hold, which I'll get into a little bit later. So I thought now it's probably worth just going through an example of how this would potentially work. And we've got a very nice case on the go at the moment. So the client has set up his SSAS. So let's have a look and see what a SSAS actually looks like. You have the limited company. And again, let's assume that this is a husband and wife limited company. They are both directors. The limited company sets up the SSAS. So it is what's known as the sponsoring employer. And both the husband and wife would become members of that SSAS. As I said, they could arrange to have transfers brought in. So if they hold, for example, personal pension plans or SIPs or even Nest, if they've set one up under the company, then they can arrange to have those transferred into the SSAS should they wish to do so. As mentioned before, the company can also make contributions to the SSAS for the members. Annual contribution allowances apply, and obviously you may be able to do carry forward of unused allowances in the last 3 complete tax years, providing you had a pension in place during that period. At the moment, let's just say they are looking to contribute up to £60,000 each into the SSAS, so 120,000. Then this company would pay in as a company contribution 60,000 for the husband and 60,000 in this example for his wife. So we've had £120,000 go into the SSAS. Now we've got a very interesting case on the go at the moment. We have a client who actually happens to have a separate limited company, and it's an investment company. And in that investment company, it holds a large piece of land. And that land is currently valued at £1 million. And the company has bought that over a period of a number of years. So members of the pension scheme, who are the same directors in this limited company, are very mindful that the land that they hold, if it goes for planning, which is what they're going to do, the land will potentially increase from 1 million to potentially up to £3 million in value post-planning. So you can see that is potentially a very substantial gain, which would attract capital gains tax at the current rate in the company of 25%. So it's an expensive rise in the value just for obtaining planning permission in the land. But they haven't gone for planning yet, so they approached us and said, can we put the land into SAS? And the answer is absolutely yes. And it's even better because I know for the fact that the planning they're looking to do on the land, they're looking to build commercial developments on that site, so even better. So they happen to have built their SAS up in value over the last few years, and that value today is £800,000. So that's the cash that they are actually holding in their SAS. So they said, can we buy the land off the company? We said, yes, absolutely. It fits all of the criteria that we require. Now, obviously, we will obtain a valuation on the land independently, so to make sure that the value that is being offered is correct, because it is a connected party transaction, so you must have an independent valuation on the land. So we will obtain that valuation and we'll assume it's worth £1 million. But you can see they're obviously a little bit short with 800,000. So we were in the fortunate position that they hadn't actually put contributions into the SAS for some time. So they had a lot of unused allowances that they could carry forward and make use of. So I don't think either of them have put any money in for the last 3 tax years. So we easily had contribution allowances for both the husband and wife of an extra 200,000 that they could make from the company into the SAS to take this up to the £1 million mark. However, one of the comments that they made was that the £200,000 contribution was actually going to leave the company a little bit short on cash flow. However, we explained we can get around that problem. So what will happen is the SAS will arrange to purchase the land. So the land will end up inside the SAS. So this process is now ongoing. We've moved the land into the SAS, and this still works even post the changes in the budget. So what will happen is the land will be sold post planning permission, which they will hopefully obtain fairly soon. And they're expecting that land to increase in value, as I said, to £3 million. So if we had left the land in this limited company, then the uplift in the value post planning would have been subject to the capital gains tax rate applicable to companies. So a fairly substantial bill, and you can understand why the members here wanted to get the land into pension. So because the land obviously is held in pension, capital gains tax is not applicable to assets held inside the SAS. So when this value goes from 1 million to 3 million, if that's the expected sale value, there is no tax on that uplift in value. So just stepping back a little bit, obviously when the SAS, we injected the funds, we bought the land off the company. So in effect, the £1 million of cash for the purchase price of the land will flow up to this limited company. So there is now £1 million of cash held here instead of the land. Obviously, the pension scheme has bought the land off the company. That £1 million of cash held in the limited company to buy the land originally. Both of the directors had injected cash into the company to help purchase the land, so they both had very positive directors' loan accounts. So it was possible for the company to repay the directors' loan accounts, which of course there is no tax on because it's repayment of capital that the directors have put into the company. So the directors now have the £1 million back in their pockets, if you like. But there is then nothing to stop the directors taking some of that money and injecting it back into their trading limited company. So they would take some of this £1 million and put it back into the limited company to help with cash flow. A perfectly legitimate thing for a director to do is to put capital into their limited company. So they would in effect replace the £200,000 of contribution that they've had to put in the pension. So you can see we can inject, say they put £200,000 back into the limited company to keep the cash flow going, but by putting a pension contribution in the first place, they've actually reduced the corporation tax bill that would be payable by the company. So this is very much moving money around in a circle, as you can see, and it's a win-win for the directors. So they win over here with corporation tax, and they win over here with the increase in value from a CGT point of view. That is potentially a massive saving to the directors of this company. Obviously, when the land, the planning permission goes through, they will sell the land, but that £3 million will then be back in the SAS and therefore back in their retirement funds to support their retirement and hopefully being able to sail off into the sunset sooner than they'd anticipated. So you can see with the capital gains tax changes that have gone on in the budget, SAS is an absolute winner for you when trying to manage the affairs and assets that you may have, and you must start looking at, can we use SAS to help mitigate the capital gains tax position on the assets that you already own. The same would be applicable if the limited company owned commercial property. We do a lot of these where we find the limited company holds commercial property on the balance sheet. The first thing we do is we turn up to the directors and say, would you like the pension scheme to buy the property off the company? And they always say yes once we've been through a worked example with them. Again, because by moving, say, a property from the limited company into the SAS, you are shutting off any future liability to capital gains tax should that property go up in value from this day forward. And as we've seen in other videos, you've got the advantage of the limited company has to pay rent to the SAS because the SAS is now the new owner of the property. That rent comes in to the pension scheme tax-free, another huge tax advantage that you have with SAS. And of course, the rent payable by the limited company is a tax-deductible expense, more savings to corporation tax. So if you own land or commercial property, whether it's in your limited company or whether you own it personally and you have a trading company, then you must have a look at using SAS to protect those assets from the tax changes that have happened in this budget. We'd love to hear from you. With the changes to capital gains tax, how are you planning to manage your assets and investments? Please comment below.
Book a call with us via the link in the description below. If on a mobile device, simply hit the More button under the video title and pick a convenient time to speak. Feel free to share this video with others that may benefit on WhatsApp or in other online groups or channels. Like, subscribe and hit the notification bell for lots more SAS related content, and leave a comment if you found this video helpful. For more, visit onecrownpensions.com.